You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and US sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive. Today, we've got a big task ahead of us.
We certainly do.
We're really digging into a comprehensive global market and geopolitical briefing for Friday, October 24th, 2025.
Yeah.
And our mission isn't just, reading headlines. It's about pulling out the really actionable, maybe surprising insights. Stuff from foreign exchange, commodities, trade policy, and all those global hotspots generating risk right now.
Right.
Think of this as your essential shortcut to getting up to speed on the day's critical moves.
And the context is, well, it's crucial today. The whole picture is really defined by these sort of conflicting forces.
Okay.
On one hand, you've got classic data-dependent trading. Everyone's waiting for the US CPI print later today.
Inflation numbers.
Exactly. But layered right on top of that, you have this intense headline risk. Comes from abrupt policy shifts, geopolitics heating up.
So it's data versus sudden shocks.
It is. It's a day where traders have got to weigh that hard macro data against these sudden political bombshells sometimes.
Okay, let's unpack this right away. Starting with the markets. Where's the immediate focus? Currencies.
Yeah, the general mood in FX is definitely nervous. The dollar's a bit firmer, but really stuck in a range.
Waiting for CPI.
Totally. It's the definition of holding your breath. Everyone's trying to figure out if inflation's cooling fast enough to, change the Fed's thinking.
Any specific moves?
We saw dollar-yen briefly poke at that 153.00 level. That's always a key psychological point. Raises those intervention whispers.
Right.
And euro-dollar slipped back a little. Sterling's also pretty steady, but it's near those lows we saw after the last CPI print.
So why has the CPI print got the market so frozen? Isn't inflation always a big deal?
It is, always. But the stakes feel incredibly high this month. You see, markets have pretty much priced in this soft landing idea for the U.S. economy. What they're really watching for is softness in core services inflation. That's the sticky part.
The services side.
Exactly. If that stays high, it just throws a wrench into the whole narrative about the Fed cutting rates soon. And that would mean a major repricing everywhere. Dollar up.
So that one data point is kind of dominating everything globally today.
Pretty much. It's the biggest macro force out there right now.
Now, speaking of managing market forces, we also saw the People's Bank of China, the PBOC, sending a signal earlier.
That's right. The PBOC set the yuan midpoint fix at 7.0928.
And that tells us?
Well, the midpoint is their official guidance rate. By setting it pretty stable, they're basically saying, look, we're not going to let the yuan weaken too much too fast.
Managing expectations.
Precisely. They're acting as this kind of anchor, which helps stabilize the overall risk mood in Asia. And that tends to help currencies like the Aussie and the Kiwi dollar, too.
Okay, now for something really interesting, the big political shockwave yesterday hitting North America.
Oh, yeah.
Dollar Canada. It popped briefly above 1.4. I mean, that's a big move.
Huge move, yeah.
And it happened right after President Trump declared all trade talks with Canada were, quote, terminated.
Yeah, that headline hit like a ton of bricks. Terminated. Sounds pretty final.
Sounds like a trade war kicking off right there.
It did. And the reason given was Ottawa's decision to cut back those tariff-free import quotas for some U.S. automakers. A clear tit for tat.
Okay, but here's the fascinating part you mentioned. The pair settled back down pretty quickly.
Exactly. And that reaction tells you everything about sort of the market's priorities right now.
So the market just shrugged off a termination of trade talks. How? Why?
Well, traders looked at that sudden political headline risk, and then they looked at the bigger picture, the dominating macro event, which is the CPI data.
CPI trumped Trump, so to speak.
Well, yeah, in a way. The market seemed to decide that this political spat, however noisy, probably doesn't fundamentally change the U.S. economic outlook or what the Fed's going to do.
So macro data is king for now.
For now, absolutely. Political headline risk took a back seat. So the Canadian dollar recovered, and meanwhile you had the Aussie and Kiwi dollars holding on to their recent gains, helped by steadier metals prices and that stability signal from the PBOC.
Okay, so currency traders are frozen by data risk. Political risk seems contained for the moment.
Yeah.
Does that same caution apply in the world of physical stuff? Let's talk commodities.
Yeah, perfect transition, because while that trade headline faded the volatility in commodities, it's driven by something maybe deeper than just a headline. It's about shifting global rules. Compliance.
Right.
Crude oil benchmarks, they've eased back from that sharp rally we saw Thursday, which was driven by sanctions news.
So prices are cooling a bit.
They are cooling, but the underlying supply chain situation, still very unsettled.
And this uncertainty, it's coming from the ripple effects of sanctions, right? Not just about volume, but who's willing or able to actually move the oil.
Exactly right. We're seeing these major shifts in global compliance across the whole supply chain. Why? Because the U.S. has been quite aggressive in targeting these corporate networks linked to Russian energy.
And the impact is showing up where?
Most immediately, you see it in Asia. Reports are that Chinese state-owned oil companies are actually suspending some seaborne Russian oil purchases.
Wow, okay. Because of sanctions concerns.
Specifically because of sanctions concerns, yes. They don't want to get caught in the crossfire.
And it's not just China, is it? We talk about compliance sometimes in the abstract, but what does it mean practically on the ground?
It means huge logistical headaches. We're hearing that Indian refiners, another massive buyer of Russian crude, they're scrutinizing shipping documents, the bills of lading, much more closely now.
Extra checks.
Yeah, basically enhanced due diligence. They want to make absolutely sure they aren't accidentally dealing with entities targeted by recent U.S. measures, like those linked to Rosneft or Lukoil.
So when two giants like China and India get nervous about potentially hitting secondary sanctions,
it sends a massive chill through the shipping markets, the insurance markets. It complicates everything.
So the key takeaway, the knowledge nugget here, is crucial. This fundamental shift in compliance, it keeps a risk premium baked into the oil price, even if the spot price cools off a bit from the absolute highs.
That's exactly it.
It's not just supply volume anymore. It's global legal risk, compliance risk priced in.
That is the ultimate so what. You don't even need new sanctions announced today. Just the complexity of enforcing the existing ones adds cost and uncertainty to every barrel, keeps prices somewhat supported, resilient.
Okay. And other commodities quickly.
Gold is sort of treading water, indecisive ahead of that inflation release. Gold is usually very sensitive to interest rate expectations.
Makes sense.
Copper, though, is holding up quite well. It's lingering near its best levels for the week as sentiment around industrial demand seems to be stabilizing a bit.
All right, let's pivot hard now to policy, because the economic tension, particularly between the U.S. and China, it's still front and center, isn't it?
Oh, absolutely. Never goes away.
Let's start with this investigative track Washington seems to be preparing.
Right. So Washington is getting ready to launch a new Section 301 investigation. This one's looking into China's compliance, or lack thereof, with that 2020 Phase 1 trade deal.
Section 301. Remind us what that means practically.
It's basically a domestic U.S. tool. It lets the government investigate and potentially penalize foreign countries for what it sees as unfair trade practices.
So launching this, it's a big step.
It's significant, yeah, because it's the step that could formally lead to more tariffs or quotas later on if they officially find noncompliance. It makes the pressure official, legal, not just, threats.
Okay, so we have this pressure cooker investigation potentially starting.
Yeah.
But at the same time, the diplomatic calendar looks pretty packed.
Exactly. Total contrast. The White House confirmed President Trump is set to meet President Xi next Thursday in Asia.
A leader-level meeting.
Yes, happening around other diplomatic visits in Japan and South Korea. And on top of that, Vice Premier He Lifeng is scheduled to meet U.S. officials down in Malaysia soon, too.
So, lots of talking, even as the policy track gets more adversarial.
The dialogue track is very active, yeah.
And we also know the U.S. administration is still mulling over that potentially very powerful policy tool, export controls.
Right. The idea of restricting China-bound goods, even if they're made elsewhere in the world, if they contain U.S. software or technology.
And the key part there, I thought, was the emphasis on coordinating with G7 partners.
That coordination piece is absolutely crucial and probably the hardest part.
Why is that?
Because, look, export controls really only work if you plug all the holes. If allies don't join in, China can just buy similar tech from them.
Makes sense.
So convincing allies like Japan, Germany, France, who all do huge business with China to restrict high-tech sales, that's a massive diplomatic challenge. But without that coordination, the U.S. controls are just less effective.
Okay, this brings us perfectly to Beijing's position, which seems, well, fascinatingly contradictory sometimes. This duality you mentioned framing the upcoming talks.
It really is a duality. On one side, you have the sort of engagement message, the olive branch.
With those like what?
Well, the Commerce Minister recently pledged, lower market access barriers, more opening up to foreign investment, basically saying, come invest, we want your business, we'll treat you fairly.
Okay, that's the external message. But the internal signals, especially from the top party levels, they seem to point in a totally different direction.
Yeah.
Right? About their core strategy.
Completely different story. The communique from the recent fourth plenum, that's a major party meeting setting long-term strategy, it put heavy emphasis on a big increase in technological self-reliance.
Self-reliance.
And boosting indigenous innovation across the board. This isn't just talk, it's a clear strategic directive. Prioritize building domestic supply chains, reduce dependence on foreign tech, especially from the West.
So help me process this for the listener. Beijing is saying, please invest here, doors are open, while also telling itself, we must build our own tech so we don't need the West. How do those coexist?
That tension, that inherent contradiction, that's the absolute crux of the upcoming talks. It suggests that maybe they want foreign capital to fuel growth.
Okay.
But they're simultaneously building a technological fortress to reduce foreign influence and vulnerability.
Got it.
And this duality is precisely what's going to make that Trump-Xi meeting next week incredibly complex, incredibly tense, because U.S. policy, like export controls, directly attacks that self-reliance goal.
That makes a lot of sense. Okay, well, let's quickly shift gears now, cover the geopolitical flashpoints. Still a very busy map out there.
Very busy. First, Russia-Ukraine. Washington's latest sanctions package, it's really honing in on Russia's energy revenues and the corporate networks that help move that money.
Hitting them where it hurts.
Moscow predictably sort of downplayed the impact, but they also signaled they might be open to a future summit.
But the U.S. put a condition on that, didn't they? Which feels important.
Very important context. The U.S. stance is clear. A Trump-Putin meeting isn't impossible, but it absolutely depends on seeing some real, tangible movement towards peace first. Verifiable steps.
And Kyiv's position.
Kyiv reiterated its own bottom line. A ceasefire could be possible, but not if it means giving up territory. Meanwhile, over in the EU, leaders are debating how they might use frozen Russian state assets to help Ukraine financially.
That sounds complicated.
Oh, hugely. They've asked the Commission for concrete options, but there are massive legal and political hurdles around actually seizing and using sovereign assets, a real tightrope walk.
Okay, shifting quickly to the Middle East. We got a pretty direct statement from President Trump about Israel.
Yeah, he stated very clearly Israel will not be doing anything with the West Bank.
And that came with a warning.
It did. A clear warning from U.S. officials alongside it, basically saying any missteps in the West Bank could seriously complicate the delicate progress they're trying to make on the Gaza situation.
One theater impacting another.
Always interconnected. And just one more quick hit, Venezuela. The administration denied some specific reports about B-1 bomber flights nearby.
Okay.
But they did flag potential land action, focusing specifically on tackling narcotics flows in that region. So that just highlights another area of regional tension to keep an eye on.
Okay, let's try and wrap this up. Consolidate these key knowledge nuggets for you listening.
Good idea.
Right, the dollar, contained for now, but highly active, really just waiting on that US CPI number to give the Fed direction. We saw that dollar Canada pop dramatic headline risk, but ultimately short-lived. Macro fundamentals won out.
For now?
Crucially, crude markets are recalibrating, not just price, but because compliance is shifting. China, India, they're scrutinizing Russian oil more closely. Logistics are tightening.
Big deal for supply chains.
And finally, the U.S.-China policy front remains incredibly dense. You've got the threat of that Section 301 probe on one side, clashing with Beijing's internal push for tech self-reliance, even as they talk about market access.
So, for your action list, what should you be watching closely?
Good question.
I'd say three things. First, obviously, the dollar's immediate reaction to the US CPI release later today. That's your number one market driver.
Okay.
Second, watch the resilience of oil prices. Do these compliance shifts, this logistical friction, keep prices elevated even if demand softens a bit?
The compliance premium.
Exactly. And third, look for any concrete outcomes, any real substance from all that U.S.-China diplomatic activity ahead of the Trump-Xi meeting next week. Any signals.
Got it. And here's the final provocative thought we want to leave you with today.
Okay.
Considering those conflicting signals from Beijing, promising lower market access barriers, more engagement, while simultaneously stressing that big increase in technological self-reliance in their big party meeting.
That fundamental duality we talked about.
Right. It raises a really important question. Which of those internal strategic priorities, attracting foreign capital or achieving indigenous tech dominance, which one will ultimately dictate China's actual negotiating strategy when she meets Trump?
Yeah, which priority wins out in the room?
We'll certainly be watching to see which hand they play.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.